Can I complain here for 1 second?
About what?
This damn fantasy football league.
Why? Oh, you got screwed.
I got screwed.
Dallas puts up 34 points on defense.
Like I lost by 3 points.
Oh, that was a tough beat. I felt bad for you on that one. I was watching that game. I was like, oh my God.
I was so excited about fantasy football, and then I got royally screwed in week 1. I don't want to play anymore.
Leka should be just as upset as you because she put up a great week, but then she was playing Cam, and Cam had Dallas. Dallas put up 35 points on defense. Dallas was the best, other than Tyreek Hill. Dallas was the best performer in the entire league. Their defense,
which is so freaking dumb. Like,
welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 15 of Drunk Real Estate. I am Kyle Wilson, more affectionately known as Ashley Wilson's husband. And once again, we have a special guest joining us, and it's a lady. Welcome, Leka.
Hi, guys. I am so excited to be here.
Well, I'm confused. I mean, we had a lady last week also. Do you say it like it's special?
It is special. We got a bunch of white dudes on this podcast usually, and we snagged Leka, big pickup. It's like fantasy football. She was the number one waiver wire pickup. So how's it going, Leka?
It's actually going really good. Do I talk about my drink now or after?
You could talk about it now. I was going to ask you, but if you want to start off with that, I like where you're going.
She's like, let me talk about my drink. Forget about the rest of the stuff. I want to talk about my drink. Leka, what are you drinking?
Well, give us a rundown first of what your deal is, who you are, and what you got going on.
All right, so I'm Leka Devatha. I live in Seattle, Washington, and I have been at this real estate investing game for over a decade. I started out with just doing single family flips, and now I buy all things distressed. I just buy distressed commercial property, multifamily residential, and then my kind of superpower is that I fix them up real good and I'm good at stabilizing them. So that's my deal. I do it mainly in the greater Seattle area. I also run a pretty fantastic investor meetup here locally in Seattle. And one more thing, I am emceeing the Bigger Pockets conference this year, which I'm super excited about. So hopefully you'll be there.
I did not know that.
Oh yeah, I'm the MC.
That is super exciting.
What an upgrade over last year.
I know. Last year I was one with the audience.
No, I just meant an MCs. Like we had Ashley last year as the MC. Not my Ashley. And I think she listens to this, so I was just trying to give
and an upgrade over the year before. The year before was Carol and me.
Oh geez, yeah. Wow, it just gets better every year.
Where have you guys been? I think Jay, if you weren't fasting all the time, you would have known and paid attention to the fact that she was MCing.
I didn't realize it. Well, now I'm excited.
So what are you drinking this week?
All right. I am drinking one of my favorite rosés. It's called BRRRR Salmon. And it's, honestly, if you guys haven't had it, you must try.
It's great. I've had that for sure. It's good stuff.
Oh, yeah.
Is the salmon the color of it or the flavor? Or?
Yeah, it's the salmon colored. So that's why it's called the BRRRR Salmon. And it's bad because once you start drinking it, you're not going to stop drinking it. And by the end of this episode, you guys, I may be very happy. And it's not my fault.
It's I'll put your topic to introduce second then, so we won't leave you to the end. So you're still good. Jay, how's it going over there?
Everything is going really well. I'm excited to be here tonight. I'm thrilled to have another lady here to join, take over some of this testosterone. As far as like all white guys, Mauricio, do you identify as white?
Let's not get into the identifying part, but yeah, I was a little offended actually when he said white guy. I felt very identified.
He's a very white Hispanic guy.
What are you drinking over there, Jay?
I went a little bit different today. Carol made me a vodka and soda with a lime, and you guys are going to make fun of me, but this is the only vodka we had, so I'm going with the Tito's tonight.
What's wrong with Tito's? Tito's is great.
Oh, I assume that it wasn't going to meet your qualifications for like sophisticated enough alcohol.
No, Tito's, they kept bumping their price. Tito's originally was cheap, but it was like really good for how cheap it was. And then they got so popular that they're now like well priced. So it's
In that case, bragging rights. I'm drinking Tito's tonight.
Mauricio, how's it going, man?
It's going good, man. I'm getting ready for my trip. I'm heading to the great state of Texas this week, and I'll be there all week. So looking forward to that.
What are you doing in Texas?
There's an event, got an event over there, the Hero event put on by my buddy Tim May, I should say. And he's got a great event that he puts on every year down in Houston. And we're going to go hang out, talk a little bit about funds and all fun syndication stuff.
Awesome. Drive by our properties down there, see how they're doing. I
will definitely not be doing that.
Fair enough. So for those of you interested, I'm drinking a little Maker's Mark. Fun story from that. I was at a charity golf tournament today, and there was a event where if you made the putt, you got a bottle of Maker's, and I missed it. But my buddy who was playing with me is actually an ex NFL football player, Ben Garland. He made the putt, but he had to get on a flight, so he gave it to me. So I got a free bottle of Maker's Mark without having to do anything.
And some name dropping.
Yeah, it's always good to those ex professional athletes. They're always great guys. All right, let's get into the economy here. It's been a couple of weeks since we did Jay's economic update, and we've had a lot of data come out the last 2 weeks discussing jobs, core PCE, GDP. We had a consumer confidence is at 106 versus the 116 expected. Unemployment rate was at 3.5 versus the previous week was 3.8. Jolt survey came in at 170,000 lower. We got a lot going on, and none of it's a lot really point towards a strong economy. So Jay, what are we looking at here?
Yeah, so I don't want to do just another economic update because I feel like I do a lot of these. So this one is going to be, kind of, I'm going to refer to this as kind of my economic nightmares. Because I do have some economic nightmare scenarios right now that I'm concerned about. I know anybody that's been listening to me for the last several months knows that I've been relatively bullish on the economy. I've been bullish on the fact that I think we're going to have a soft landing, whatever that means. But after the data, like you've said, that we've seen the last few weeks, I'm starting to become a little bit more skeptical. I'm starting to think that it's possible that the Fed has overcorrected with their 5.25 point rate hikes. And while I might not be as concerned as Mauricio is, I know Mauricio is thinking we're going to have some big crash. I may not be that concerned. I'm a little concerned that we may have overcorrected and we may be in for something worse than what we were thinking. And so
I thought this episode was going to be called the Mauricio was right episode. What happened?
Well, that's the one that we're going to get in a few months if you are right. Otherwise, it's not going to.
Hey, I was with you, Mauricio, on the correction next. What would we say? Q1 next year?
No, I said it was going to be next. It's coming up. It's the next, September, October. Then we're right in the middle of September, October.
So anyway, we keep talking about this soft landing, and I guess it's an airplane metaphor when we talk about a soft landing. But for there to be a soft landing, you got to have a landing. And my concern is that if you think of like the economy as an airplane, we were flying at 40,000 feet. Everything was going really, really well. And now the Fed raised rates 5.25 points. And so we've gone from 40,000 feet to now we're cruising at like 20,000 feet. Problem is we're still not landing. The economy is not softening enough that like we're really coming towards like a point where we can say inflation's been fixed and everything else has been fixed. And the problem is when you're cruising at 20,000 feet, if something breaks on that airplane, you're not going to land. You're gonna nosedive and you're gonna crash. And so there are a few things that I've been concerned about. Again, I'll call them my nightmare scenarios of things that could potentially break this economy at 20,000 feet and cause us to nosedive. So let's start with number one. Number one is inflation. And I know we've been talking about the fact that inflation's gone from 9% down to 3%, and everybody thinks inflation's under control. But here's the problem with inflation. The Fed has been hiking interest rates specifically for the purpose of quashing inflation. And they do that because by hiking interest rates, they hope that they slow down demand, consumer demand. They hope that they slow down the economy. People stop spending money, and that lowers inflation. Now, inflation has come down over the last year and a half, but it hasn't been because demand's come down. It's been because supply chains have opened up and that's caused inflation to come down, but supply chains are open now. They're not opening up anymore. It's been that oil prices have come down, and that's really helped inflation a lot, but oil prices aren't coming down anymore. And it's been lower rents. So we've seen lower rents over the last year or so, and that's helped inflation come down, but we're not going to see lower rents moving forward, I don't think. So the only thing that's going to really move inflation moving forward is lower demand, but it looks like things are starting to heat up again when it comes to demand. We have some preview Q3 numbers that make it look like GDP could be like well above that 3%. That's kind of that scary number for us. If it's above 3%, we're likely to see strong wage growth, and we're likely to see higher inflation and all these other things. And it's looking like that demand's not coming down. So my first big concern is that there's nothing that's going to drive inflation down at this point except lower demand, and we're not seeing lower demand even at 5.5% interest rates.
So you're thinking inflation is going to start trickling back up? Is that what you're starting to see? I mean, what are you looking? What do you think it's? Are we talking about going back up to 9% again, or
I don't think we're going back up to 9%, but I mean, we'll know a lot more tomorrow. So this episode, or actually, we'll know a lot more today. This episode's coming out on Wednesday, and we're going to get the CPI numbers for August today. So we'll have a lot of information today about where things are going. But I suspect that if we don't get demand under control, we're not going to get inflation under control. Literally, demand is what's driving.
But if you look at projections for this month coming up, yes, if you go do the year over year, just because of the whole replacement factor where it's replacing a low number, it's going to be technically go up year over year. But if you look at the monthly, they're projecting 0.2, which would put which is 3 months in a row. And if you annualize a T3, that puts us at 2.4% for the core. So that's like, isn't that right where we want to be?
It is, but I suspect that, again, a lot of that has to go to the first three factors: opening up of supply chain, dropping of energy prices, and lowering of rents. The problem is energy prices are starting to go back up. Supply chains are already open. Rents are starting to go back up. And so really, literally, the only thing I see that can drive inflation down or keep inflation down right now is lower consumer demand.
I disagree on the rents, though. Like the rents, yes, rents real time that we're seeing are going back up, but the rents that factor into CPI, we still haven't seen the rents come down because it's such a lagging indicator. We talked about this last week where if you use other indexes that take into real time data for rental, then like inflation's much lower right now than it is. So I think the opposite. I think rents are going to hit and it's going to drive it all down. Yes, gas, we can't really affect that. But if you take that out and just take the core numbers, which shelter component is like 40% of the core numbers, then once that shelter that actually hits our CPI and our PCE, then we're going to see some real low numbers.
I'm not so concerned about the actual number. I'm more concerned about what we're seeing in the real world. And we could see a low inflation number. We could see a low CPI number for the next few months. And I think we will, because again, the way, just like you said, Kyle, the way the math works, I think we will see low numbers for the next few months, but I'm concerned that it's not really going to get inflation down. And that's going to be an issue longer term. So that's number one. Number two, and I think we can all agree on this one, is treasury yields. And so what we've seen over the last couple weeks, last couple months, is that treasury bonds are spiking. Like 4.3% for the 10-year right now, which is well above what I think we all thought it was going to be at this point. We were close to 4 about a month ago when we had our predictions episode. And I think most of us, I don't remember, I think maybe all of us thought that we had kind of topped out on 10-year treasuries or treasuries in general, but we're seeing those go up more. And when we see treasuries go up, I mean, the biggest thing we need to see for a soft landing is treasuries going down, because these treasury rates are kind of what drives the cost of everything. It's what drives mortgage rates. It's what drives borrowing and credit card rates. It drives the ability for businesses to borrow money at reasonable rates. And if bond yields don't go down, I think we're going to see a lot of things break. We're going to see, we're going to see mortgage rates continue to go up. We're going to see businesses who are struggling. A lot of businesses borrowed money 2, 3, 4 years ago, just before, right around the time COVID hit, and now they're coming up on their refinance or having to recapitalize on this debt that they took, and they're going to have to do it at rates 3 times as high as what they took out a couple years ago. And so I think if treasuries don't start to come down, that could potentially be the thing that kind of breaks the back of the economy.
But Jay, just going back to the treasury, GDP is actually down to 2.1% from 2.4, and then that combined with low job openings, I think the yield went down from 4.21 to almost 4.08 or 9. So I think the combination of the two is actually dropping the 10-year treasury.
Yeah, but you mentioned the 2.1 GDP number. If you look at the Atlanta Fed, just a couple days ago, they put out an estimate for Q3 GDP at over 5%, like just some ridiculous number. And so, yeah, Q2 was lower, but we're seeing increased spending again in Q3.
Once again, they're just going to revise it back down, though. Like that's what they've done every single month is, oh, here's this crazy number. And then, 3 months later, oh, by the way, page 6 of the newspaper, we revised that down another 20%.
Yeah, but what 5% revised down even 20%, which is a huge revision downward, is only 4%, or it's still 4%.
But do you see it going from 2.1 to 4%?
Do I? No, but I'm not the Fed. And again, this is the number that's being bantied around right now. Now, the other interesting thing is that when we talk about this recovery that we've seen since COVID, it's been very much a K-shaped recovery. So you look at earnings for companies like Dollar General or whatever the other dollar store is that's publicly traded, and they're struggling right now. And a lot of other companies that kind of focus on the lower socioeconomic end of consumer buying, they're struggling with earnings right now. But then you look at the higher end, you look at the Macy's, you look at the I'm drawing a blank on a couple of the other companies, but that focus on more luxury type goods.
Nordstrom.
Yeah, exactly.
Jay doesn't spend a lot of time in high-end stores. So
that is very true. My Old Navy shirts. But those are doing really well. Earnings are through the roof. And so what we're seeing is that a certain segment of society is making a lot of money and spending a lot of money. And then this other segment of society is struggling. And I think that's potentially a big issue as well. So, but going back, treasuries, big potential issue. Third one I'll point out is oil prices. And oil prices, energy in general, is a big component of CPI, but more importantly, it's a big component of all the things that actually impact our daily lives. I mean, it hits tourism because people don't want to travel. Energy prices go up. That means airfare goes up. It hits things like just retail goods, because most goods are shipped around the world, or at least around the country, so we have to pay higher gas prices. Well, we're going to pay that in higher retail prices at the register. And so I think oil prices continuing to spike is going to be bad. Saudi Arabia and Russia just announced a couple weeks ago, or a couple days ago even, that they were not planning to ramp up production for the end of this year. They cut production a few months ago, and they're not planning to ramp back up. And so that caused oil to go back up by like $10 a barrel. And I think this.
There's nothing we can really do about that, right? Like the problem is that politically, Russia's not a big fan of the U.S. right now. We have all the sanctions on them. Biden went through this time where he was publicly basically shaming the Saudi crown prince. So the crown prince isn't necessarily a huge fan of him. So like now the only saviors they're trying to strike a deal with Venezuela. I heard they're trying to get in there to like run free elections there and get them to ramp up their oil production. And then our next savior is Iran. They're trying to get in tight with Iran. So when you hear those two names as our like allies that we're relying on to solve an issue, I don't think I have a lot of confidence in it working out.
I thought our savior was the Strategic Petroleum Reserve. Are we tapped out of that, or what's going on there?
They haven't refilled it at all. So, but
here's the thing: we are the largest producer of oil in the world right now. Literally the largest producer of oil in the world.
But we consume as much as we produce.
That's the problem. And so yeah, we are net positive on energy production. We produce more oil or more energy in general than we use. And so we are net positive, but the problem is it's really close, and we export a lot of our oil. We don't keep it internally, and we bring a lot of our oil in from other countries. And so Yeah, you're right. This isn't something we can control, but that's why it keeps me up at night. Well, I sleep pretty well.
I think it's a lack of food. I think it's a lack of food that keeps you up at night, Ray.
Yeah, that too. But I mean, that's part of the reason why it's one of my nightmare scenarios, because we have no control over it.
I mean, worst case scenario, I don't know exactly how it works, but since we are like a net zero, like, couldn't we kind of just take care of ourselves first?
We could, but it's a huge component of GDP. Other countries pay more for our oil than we would pay ourselves, because there'd be internal pressures to drive prices down internally.
Yeah, I mean, I can almost see the gas station across the street from my office, but last time I checked, it was granted, I'm in California, right? Southern California, but it's $6.20 for the expensive stuff. And then diesel, which used to be one of our Jeeps is a diesel Jeep, was the lowest per gallon. And now it's up to $6.30. So diesel prices have also gone up through the roof. Like, from a percentage change, diesel's really gone up in the last, probably just a couple months now. It's probably up from in the, in the mid fours to low fours. Now it's in the low sixes. So that's almost like a 40% increase.
Well, and don't forget too, we're about to have student loans. People are starting to pay those back. It's just coming up in a couple of weeks. So I can't decide whether that's going to be a big deal or not. I feel like it might be.
Well, I mean, if you think about the fact that that personal savings rates are down to 2008 levels, and credit growth is still continuing to go up. I mean, we added 10 billion to our total consumer credit number last month alone. I mean, Americans are still spending, and so it seems to me like they don't want to stop, even if they don't have any money, and they're taking it out on their credit cards.
Can I put some numbers on the household savings? So I wrote this down to house because it's just staggering. The household savings in 2021 was 2.1 trillion. Right now, it is 190 billion. So like a change of the first letter from trillion to billion, all the way down, which is just mind-boggling to me.
And let's not pretend this was savings, right? These were all the helicopter money that we were all sending out checks and depositing in our accounts. But look, I don't know. You look. I thought this was the Mauricio was right episode. But I mean, if you all of the stuff you mentioned is fine, but all of that goes out the window if you have a sudden recession in the country, right? So if recession hits, whether it happens this year, beginning of next year, that's where your demand disappears. I can guarantee you demand is going to evaporate when you have unemployment rate, which is what the Fed's trying to do, go from whatever it is today to 4, 5, 6%, which is what they're trying to do. Then people are going to lose their jobs. People are going to start, you've heard my argument about the housing. I still think people who, don't want to move from their housing. And like, I know you're going to talk about the housing. You're way more in tune with the housing market than we are. But yeah, people don't want to move from the housing market because they have really low mortgage rates and all that fun stuff. But at the end of the day, when you get unemployed and you got to pay your bills, you're going to tap into that equity by selling, and you're going to have to cut back on those vacations when you don't have a job. And suddenly all of that demand starts to evaporate, which is sort of the definition of what's going to happen in a recession. And look, for inflation, I think, we've been talking about it on this episode, and I've talked about it a lot. I mean, I don't think inflation goes up and down in a straight line. I think you're going to see inflation. I would not be surprised. I think we have a bet on this, Jay, at some point. But I think I don't think we ever actually settled on an actual bet. But I would predict that inflation will be higher than 9% by the end of this decade, because inflation tends to go down. Then the following year it'll go up, and then it'll go down. And it never happens in a straight line. Just look back at the 1940s, where at some point inflation in the 1940s, which overall was super inflationary, went below zero. At some point it was deflation during that time frame before it then shot back up and hit double digits. So I think all of that's still playing out. Oil prices, for sure. Oil prices are problematic, but I think at the end of the day, what's the most problematic is just the lag effect of these interest rates, right? Interest rates are going up. The Fed funds rate is going up. The Treasury yield's going up. So, in our world, real estate, more and more people are having to refinance. More and more people can't refinance. More and more office buildings that we've talked about before are having issues, and that's just going to come to a head. And I think it's still going to come from the banking sector. I still think that everybody's saying, hey, it's a soft landing, everything's contained. Guess what else was contained back in 2008? Subprime.
Yeah, but the banking sector, though, like, they got a pretty sweet deal right now. Like, they're basically getting free money whenever they need it. They could take any treasuries, however long they're dated, however underwater they are, and just trade them in one-to-one for cash. They could get liquidity immediately whenever they need it. So, and we can't, 2 years? We can't find out who took these quote unquote loans for 2 years. So they got a pretty sweet deal, and it's going to take a lot for they solved that problem that happened before, I guess.
But what happens in 18 months? Because that's always coming up. So 18 months, we start finding out who these banks are that were borrowing money. You don't think there's going to be some focus on those banks?
They'll probably just extend it.
But I don't think it's going to be when we talk about banks. I don't think it's going to be the banks that are going to take the brunt of this. I think it's going to be business owners. I mean, banks would get hit if it were real estate because of their extensive real estate holdings. But the reality is most real estate loans are 7 to 10 to 30 years in length. And so borrowers, barring any major life circumstances to the contrary, can wait things out. Business owners can't. Typical business loan is 3 to 6 years. And so a lot of those are going to hit a cliff over the next year or two, especially in the venture capital world, where venture capital, typically when they make an investment, those businesses have a 2-year runway. And so when they run out of money, I mean, here's another thing to look at. 68% bump in bankruptcies for small businesses in the first half of this year over last year. A lot of small businesses are going bankrupt. And we're seeing that in terms of we had 514,000 people who claimed unemployment, 514,000 more people who claimed unemployment last month. Where are these people coming from? Because we added 187,000 payroll jobs, which sounds great, but now we have 500,000 more people who the previous month didn't say they were unemployed, who are now saying they're unemployed. A lot of them are small business owners who have given up on the business and now they're looking for a job and there just aren't enough jobs out there for them.
Is that necessarily like, I don't know. I know there will be some that probably should have made it, but won't because of this situation. But it's the same thing of like, isn't it kind of culling the herd a little bit where you're like, you know, the cream of the crop's going to rise up and they're going to thrive in this situation because some of the ones, you know, these zombie companies and the ones that maybe rely a little bit too much on debt are the ones that are going to fail.
Yeah, but you want those businesses, you want 20% of businesses to fail a year. I mean, 80% of businesses are going to fail in 5 years. So it's 16% of businesses a year failing if you do a kind of a rolling average.
So if 80% is going to fail in 5 years, wouldn't it be better if 80% just failed the first year and then we just, you know, get on with it?
That's fine if you don't mind 8% unemployment.
Yeah, but where are people going to get jobs? So that's the whole point. Where are people, if businesses start to fail, who do you think is going to get laid off?
That's perfect because that's all the Fed wants is for everyone to lose their job. That's literally what they're waiting for.
Exactly, and that's what's going to happen. There goes your demand, and there goes your demand, Jay. When all that stuff happens and people start getting laid off and unemployment's at 6%, there goes your demand.
Yep, and I think I said this in our prediction episode or maybe another episode, but I'm still going to go out on a limb and say if we have a big economic event, it's going to be around businesses. It's going to be around.
So let's go around the herd then. So Mauricio, you changing your timing? You still think we're going to see some sort of major event?
No, you look historically, it's and there's a reason for it, but it usually happens, you know, either at the end of the third. It always happens at the end of the quarter, and it's usually September and March. That's just the way it is because companies are starting to move things around to get their balance sheets in order. I'm still saying something towards the end of September, beginning of October, and we're kind of entering that.
Leka, what do you think? First of all, do you think we're going to have a recession? Do you think it's going to be a little one, a big one? And when do you think it's going to happen?
You know, I think it will be soft. I feel like a lot of economies are already seeing it at this point. Obviously, it's region specific, but like if you just looked at the housing market in my area, we are not even seeing any. It's still a very, very strong sellers market. And I feel like a lot of factors have to drastically change. Like people have to start just dumping houses on the market for it to change in my area specifically. So I feel like it will be soft, and if it happens, it has to. I mean, it will happen this year, and next year will be a year of correction and growth.
I've been hearing a lot of end of next year as opposed to earlier than that. But Jay, what do you think now?
I think I just like to go against the grain because I was saying soft landing before anybody was using that phrase, and now that people are actually talking about soft landing, I'm starting to get concerned that that we've overcorrected or the Fed's overcorrected, and I think this is going to be worse than what we were expecting.
And I think the key to that, by the way, and I love it because anytime I see this in news, the moment everybody starts saying, "Oh, we're not going to go into recession anymore," "Oh, you know what, we are going to have a soft landing," and when things start getting really rosy, that's when the bottom falls out.
Historically, the Fed's been the worst predictor of their own actions as well. So We'll see how that works out. Shall we shift a little bit here to something a little colder? You see where I'm going with this? Let's talk about the BRRRR strategy. We got Leka on the horn, and we don't really have a lot of BRRRR going on between the other four of us usually. So we thought we would take the opportunity because it's a big topic that's been going around. For those of you who don't know, BRRRR is a bit of a wealth strategy where it's become super popular prior to these interest rate hikes. It stands for buy, rehab, rent, refinance, repeat, and allows you to accumulate properties while recycling capital, which obviously is pretty important. But as the name suggests, one of the major pillars of this is refinance, and the financing terms have changed quite a bit over the last couple of years with the skyrocketing rates. So, Leka, do you think this has changed the BRRRR strategy? Is the BRRRR strategy dead for now, or can you still get deals done? How's it really affected it?
Yeah, so the BRRRR strategy has been a huge way for me to acquire and maintain my rentals in a very hot market like Seattle, because our median sales price in Seattle is almost $1 million, about 950. So in a market like this, the only way that I could actually have a rental portfolio is if I bought the property super distressed, I fixed it up to instantly raise equity, and then did a refinance to get any invested capital out in order to go back and buy another distressed property and then repeat the process, hence the BRRRR. Lately, though, what I'm seeing is, there's not a lot of inventory, because if you see, 83% of the US population owns their homes, whether it's primary or investment properties, for under 5% interest rate. Now, these guys are not putting their homes on the market because they're never going to be able to find another property with a lower interest rate. And so we don't have much inventory. That's the biggest issue. But then with just how interest rates are positioned right now, a conventional interest rate is anywhere from 7 to 8%, and a DSCR is your debt service coverage ratio. Loans are at 8 to 9%. Now, a DSCR loan was traditionally amazing because they don't go after your personal finances. Instead, they go over the property's cash flow. And because rents were high and you are significantly improving the value of the property and your investment in the property is low, what happens is you were able to get out enough of a cash. You could actually do a cash out refinance because your rents would support it because the interest rate was much lower. So what I'm seeing now, though, is no matter how cheap I am buying the property for, first of all, it's impossible to find a good deal. But even if I did, and I significantly raised the value of a property, like I bought a house for like $500 in North Carolina, and then I fixed it up and it was worth like $865. The interest rate I'm getting on that is almost 8.5% because it's an investment property. And at that rate, even a rental income, which is typically a rent in that area is about $3,000 to $3,500, and I'm getting $4,000, it still doesn't cover my mortgage. And so it's getting next to impossible to do a traditional BRRRR where you stabilize by renting to long-term tenants. So it's getting super effective to start doing creative exits on this and creative ways to generate cash flow. Like some of the things that I'm doing are short-term rentals, renting out to adult family home operators who then, just pay you more rent for the same single family residence, renting by room, which is so cumbersome in its process, but great way to increase cash flow. So you have to get, like what I'm seeing is you have to get creative just to get positive cash flow.
On these, so these new loans that you're getting, are they just like, are the interest only fixed for a while, or do they have balloon payments, or like, is this something that you could see as temporary? Like, hey, I just got to get this 8.5% loan right now. The moment we see some sort of change, I can refinance into that 5% and I'll be fine.
Yeah. So the hope is that interest rates will come down, right? So in the meantime, I think the best way to get a loan is, or the cheapest way to get a loan is to do an interest only, like a short-term loan, 5-year or 7-year. So I'm not doing a 30-year fix because, those are expensive. A 15-year fix is more expensive. So we're hoping to do just interest only short term and then refinance, negotiating prepayment penalties, like so many creative ways to structure these loans, but it's not as easy as it used to be. And the other thing too is appraisals. Like, even though your property is fixed up to the nines, appraisals are coming in low because there's not many sales in the area that support a high value. So it's just overall and then appraisers are even counting down the rent. Like, typically if the rent for the area is about $4,000, I just got one appraised for 2,500. I was like, wow, do you want me to actually sign a long-term lease and then show you that this can rent for a lot more? But
What are
appraisers
they basing those lower numbers on? Why are they discounting it so much?
they're just being super cautious at this point. They're just being super cautious. So that the loan amount that they give you is lower, and then you can pay that monthly payment.
So are you having to cash in?
If you don't want to leave any investment in.
I was going to say one of the strategies I've seen for BRRRR investors over the last year or so is it used to be advantageous to do like a big rehab because then you could show the appraiser that you've bumped up the value considerably and get more chance of getting a high appraisal and getting all or most of your money back out. These days, when it's near zero chance of being able to refi everything out, I'm starting to see a lot of BRRRR investors who are doing much smaller rehabs. So, I mean, they're still not getting all their money out, but at least that delta is smaller just because the total amount invested is smaller. And so they're doing just meager rehabs. They're more like rental type rehabs, not high end rehabs. So that if they have to leave cash in the deal, it's less cash in the deal.
Wait, Kyle, I just thought about your question. Yes, I am actually leaving significant amount of cash in the deal. I'm not doing cash out refinances like I could before. I'm actually leaving all of my investment. Like, say I put down 20% to bridge the gap. I am leaving that money in the deal. So it's not a cash out refinance, but I'm just owning this property at a higher value in the hopes that if I owned it for 2 years and my rent barely covered my mortgage, I'm still appreciating my asset and I'm able to sell it for a much higher price in a couple of years.
Yeah, and I think this is just one of the issues of today in general. I mean, it used to be that for about a decade, it was a great time to cash flow in single family real estate. And these days, the cash flow just isn't there. And so if you're buying with the intention of like buying 3 or 4 or 5 rentals and then being able to quit your job next year because you have enough cash flow to survive, it's just not feasible. I mean, these days you need to be buying for other reasons. You need to be buying for the long-term hold so that either you're forcing appreciation through renovations or you're holding long enough that the market's going to catch up and give you some natural appreciation, taking advantage of the tax benefits, taking advantage of the long-term loan pay down benefits. I mean, those are the reasons you should be buying real estate right now. If you're buying for cash flow, you're going to be disappointed.
Isn't this a good chance though, Leka, for, using, here's the syndication trying to come in with the OPM, using other people's money. But I mean, if you've got built-in equity, which you have, because you bought it at a great price, it's appreciated quite a bit. You just can't get the right interest rate. I mean, there are plenty of equity raisers out there that have the money to loan you. I mean, can't you give them a piece of the pie in order to get that low rent? I mean, if I came in and said, look, I'll give you a loan for 5% or 4%, but you know what? I know you made a couple $100,000 on this deal. Give me 10% of that as well. Is that something that you guys have looked at in terms of a creative way to get out? That way you get access to capital. Yeah, you've got to give up, instead of the interest rate, you got to give up a little bit of the profit that you got, when you rehabbed it.
I like it, Mauricio. A little crafty there.
No, absolutely. I am actually I am constantly raising private money because my deals cost so much money. And so I have structured them in so many different ways where I don't even pay them a 5% interest rate, but I just give them equity in the deal, like 15%, 20%. Another amazing way to buy deals in this market is seller financing, because sellers only typically ever ask for 5%, maybe 6 at the max. I've never seen a 6, but it's like 4.5% to 5%. So that's another great way is you just partner with the seller themselves. And for the seller too, it's a safe investment. Like they're still on title or whatever, however you structure it. and then eventually they sell to you. But they get that monthly cash flow, and then you don't have to go to the bank to get financed. That's another way.
Yeah, we did an episode a couple episodes about the seller financing, and AJ was talking about how it's kind of coming back with force because, I mean, the good thing about the changing interest rates and debt environments is people are getting creative and they're more willing to work with you, maybe to get their price or to, kind of make it a win-win for both sides. But the biggest problem that I'm seeing with these ones is just, and you alluded to it, is like, how do you predict where interest rates are going to be a year from now, 2 years from now? And we're seeing it with underwriting as far as like it's almost impossible to pencil a large new construction deal because what do you use for interest rates? Like I can put in what a construction rate is now, but as far as, it takes 18 months for us to get this from ground to completion. What are the interest rates going to be in 18 months? I have to say, okay, what are they now and bump them up a little bit, but do I believe that they're actually going to be at that rate? No. But if I want to get investors, I can't show them, hey, my interest rate right now is it's 6%, but I believe in 18 months it's actually going to be down to 5%, and that's what I'm underwriting. No one's going to invest in that. They always want to see kind of a cushion, and you go to above what they currently are now. But how can you tell? How can
the other thing too is only doing projects in high demand areas for me, and there's a few markets in Seattle where, because the median price is $1 million, if you can actually put out an awesome product for 600, 700, 800, people are still all over it. We're like, just last week, we saw 2 homes go pending for $100K over ask because they were under that median price point, and also because they were fully fixed up. Another thing is, buyers these days, they don't want to come in and fix up homes. Like, they don't want to buy anything even close to like, oh, this project needs a roof. Like, we don't want to deal with that. So they want a move-in ready, fully buttoned up house that they want to buy, and they'll buy. And we're still seeing a lot of buyers who have the money sitting on the sidelines. Their purchasing power has tremendously dropped, but there's so many more people in that price bucket that it's still, creating a high demand market.
Yeah, and Kyle, to your point, and I know we've talked about it too before, but I mean, the scary part, or the thing I would caution people in general is be careful what you wish for, right? Because interest rates may come down, but they may come down for the wrong reasons, right? If we get into a huge recession and we have a drop in demand and prices go down, yeah, you'll see the Fed. I predict the Fed will come in and start cutting rates left and right, which will then should affect the 10-year, should affect mortgages. But if the mortgage goes down to 5%, but your properties decline 20 or 30% in value, you might be better off at 8% with the current value. So again, we can't predict the future, and obviously there is no such thing as a real estate market, right? To Leka's original point, it's all local stuff, right? So her market in Seattle is completely different from the market here in San Clemente, California, which is different from, wherever the hell you live, Kyle. But yeah, so it's all a localized market, and some places will do better than the other. And I think when people try and do those broad stroke analysis, it doesn't work because the micro, like, I'm actually shocked, to be honest with you, just from my perspective, that Seattle is doing so strong. Because in my perception is, it's kind of like California, like, people are bailing on Seattle left and right, but obviously that's not the case. There's still a lot of strong demand, and it'll be interesting to see if that continues.
That is kind of a perfect storm, though, if you want to talk about someone like Leka. If something happens where we have a recession and the Fed has to cut rates, then that's perfectly positioned for, okay, now we have lower rates. Now we have some distress in the housing market. Now people can come in and that BRRRR strategy just picks right back up again.
I think that's where you'll get a lot of seller financing too. I think that's going to be a huge market coming in because, yeah, some people have a lot of equity in there, but when a lot of people start losing their jobs and they can't make their mortgage payment, that's when they'll be a lot more open to doing some creative stuff because they don't want to have to, they don't have the money to go pay the 6 months in arrears. So somebody like Lake can come in, pay the arrears, and then just buy the property either subject to or with seller financing.
Like, if I'm buying a commercial property here, which I do all of my investments in Seattle, you guys, except for my one property in Raleigh, 99% of my investments are here in Seattle. And I just underwrote a deal that is a seller finance deal. And the seller was asking for $4 million for this apartment building. And the only way someone would give it to him is because he would finance it himself. So it's win-win for the sellers too, because they can then get that higher price point. back to like 2020 prices, but only because he's financing it. And it's a win for the buyers, because buyers can absolutely not get a loan for that project, because even if they tried, their loan amount would be much smaller, and it would be about 8 or 9%. But in this case, they could actually buy a distressed asset that is seller backed and fix it up, so that if interest rates changed in their favor, they could actually refinance, or at that time, like, sell it. There's more exit options.
I wonder if we're going to start to see a lot more equity funds focused on single families for this reason. I mean, if you're doing a lot of these BRRRR investments, if you're doing it professionally, let's say, and it doesn't make sense to do it with debt because, one, you need it up front, there's risk, it costs more, but you could do the same thing with equity, where, yeah, it's going to cost more than debt, but you don't need the money up front, or you don't need to make payments every month like you have to do on debt, and there's less risk to the operator. I wonder if we're going to start to see more equity funds focused on doing these single family deals. Like
there's already so many, though. I wonder how, like Blackstone has like a freaking $50 billion. I mean, they're the ones buying up all this inventory, right?
You guys, I did see a stat that blew my mind. Redfin, I think it was, reported that last month we saw 43% less in investor purchase compared to just, single family home buyers, like primary residents. So 43% less from an investor standpoint, which I'm guessing all the new investors, investors that don't really have to buy or invest right now, are just exiting the market cold.
Or HGTV had a blackout for a month, but
for the first time in a really long time, you can now buy a new construction house for about the same price as an existing home, which is just nuts. I mean, there's no reason to buy existing anymore when you can just go out and buy new construction.
Oh yeah, other than location and stuff. But if you believe Mauricio, though, the BRRRR investors should be having low interest rates and some distress in the housing market coming up in the next couple of months. So just hang on to your shorts.
I really hope something does happen. I don't want something to happen, but part of me is like, oh, if something happens, I can.
Then we could just do like a montage of all the times that you've said it's going to happen, and then we could that could be our marketing material for like a good.
It's like that joke, right? The broken clock is twice a year. I'm just going to keep saying something's going to happen, then eventually it will, and I'll be like, see, I told you.
Prove Maurice wrong.
Well, because if you're wrong, no one really cares. But if you're right, then like that's marketing material for the next 10 years. I know some people who called the great financial crisis, and they still use that as their mantra that, hey, I called the great financial crisis. Come listen to me.
It's like it's the old joke. It's a joke that says, yeah, these guys have called 14 of the last 2 recessions.
Exactly.
Kiyosaki has called for the biggest collapse in history every year for the last 15.
All right. Well, let's move on to our next topic. And once again, we want to take advantage of having Leka on the show. And she mentioned that she invests in some smaller multifamily properties and does some commercial stuff that's not quite as big as what we're doing. And we talk a lot about syndications on this show, mainly because we have 3 syndicators and 1 syndication attorney. But syndicating is not always the best way to get money for your deal. And for one, syndication can be pretty costly if you're doing smaller stuff. So Mauricio, once again, our free legal syndication attorney here. At what point is syndication worth like the time and expense of going through it?
Oh man, I love this question because it does come up a lot, and people either call us and say, "Hey, I'm doing this deal. It's a insert excuse here. It's a small deal. It's just my mom and dad, or it's my cousin or whatever." And so I'm going to structure it this way or structure it that way. So I think there's a good opportunity to kind of do a little review on this and use the sort of the BRRRR strategy or single family is a good example. But I think the important thing to remember is that, whether you're doing a syndication or not, you don't get to make that decision, right? It is what it is. The facts will dictate whether what you're doing is a syndication, which means you're legally selling securities and therefore have a bunch of compliance, or not, or maybe you are selling a security, but there's some form of exemption. But just calling it, an exemption, or calling it a joint venture, or calling it a partnership, or whatever you want to call it, really doesn't matter. It is what it is. So my good friend Tom Wheelwright likes to say, if you want to change your tax, you've got to change your facts. And I always like that saying, and I've started to use that towards this one. Like, if you want to change the fact that this is not a syndication, then you probably need to change your facts to structure it in such a way that it's not a syndication. And there are a lot of ways you can structure, especially when you're talking single family, one investor or sort of smaller deals. There are definitely ways that you can structure them. Now, specifically, the BRRRR method is obviously one. The other, there's a lot of, like, you don't do a ton of short-term flips, right? Or maybe you did in the old days, but you still do flips. Here's my favorite. So there's a couple of strategies that you can use if you're doing, let's take the flip, for example. So one of the classic ones is if you have a promissory note, for example. Now, notes are super complicated because it's so nebulous, and it's one of the most difficult questions to ask. I get this all the time. A promissory notes securities? And my answer is generally yes by default, but then there's 1,000 different exemptions that you can use. But one of my favorites is just, if you have a short-term loan, like something that's less than 9 months, that by definition is not a security. So if you're a flipper, for example, and you want to get a loan from an individual like Mauricio, let's say Leka's going to do a flip and says, Mauricio, I need 50 grand. I only need it for 3 or 4 months because I'm going to buy this thing. I'm going to fix it up. And then
we already went through, all of her houses are $1 million. So I don't think 50 grand is going to cut it.
Oh no, I do $50,000 loans all the time.
Yeah. So you get those scenarios where you can, whatever the amount is, but as long as it's less than 9 months, right, without any extensions or whatever. And so that works in some cases. Obviously, in our world, commercial, that doesn't work because you're going to do a 2, 3, 4 year project. But if you're doing a short-term 3, 4, 5, 6, 7 month flip, then having one investor, and that's the key on these deals, is you want to have one investor per deal. When you start getting multiple investors coming in with several notes, that starts to look a lot more like what we call an investment contract, which is a security. But that's a great one, loans, for example. And then obviously, if you only have one partner or potentially 2 partners, you can just bring them in as legitimate partners. And as long as everyone is actively involved, and to me, that's an easy, with 1 or 2 people, just make everybody a co-manager, just make sure that everybody's actively involved in all the decision-making things, then that could be a legitimate joint venture. What you cannot do is have just a ginormous amount of people, which is typically what I see, right? People come in and say, I saw somebody came to me the other day. It wasn't that came to me directly, but was telling me the story that somebody had 22 people in their deal and they were trying to call it a joint venture. And I'm like, there's just no way 22 people are actively involved in your particular scenario. But if you've got 1 or 2 or 3 investors, that's a good way. A secured loan in first position, not as cut and dry, but that's also a pretty good set of facts that you could argue where if like say Leka's going to buy some, like right now, if she wants to cash out on and is looking for a loan that the bank's charging too much, and I want to come in and give her a loan and secure it in first position, therefore I'm securing it with real estate, that's probably exempt. It's technically a security, but it fits one of these what we call family resemblances. Any home that's secured by a mortgage would be.
Now, does the only form of payment have to be through interest payments, or can you also have like a kicker?
The kicker is what really turns it into a profit share, right? Like the kicker is what it turns it into a security, because a typical promissory note doesn't have a kicker. A promissory note is going to be, it's just straight interest rate. But again, in the scenario that we were talking about, I could certainly come in, Leka or probably already has an LLC in there, but if I came in with some capital and said, hey, you're not even giving interest rate, you're just giving 15%, you could do a profit share, but the challenge there is that I'm going to be passive. So I would just come onto the LLC with you. I'd be a co-manager of the LLC. I would be contributing 15, whatever money I'm contributing, and in exchange for that, I'm getting 15% of the deal. And as long as I'm a co-manager with you and making the decisions alongside of you, then that's going to be exempt from being a security. So it doesn't always have to be a security. What I always harper, though, is just whenever you're doing these things, is just keep that in mind. Just because it's a small amount, just because it's a loan in of itself, doesn't mean that you're somehow getting around the securities laws. In fact, if you look at the definition of a loan, right, a note, that's the first word on the definition. A security is a note, comma, and then it goes on and enumerates 50 other things. So by definition, a security, you should think about, hey, maybe this is a security, and if it's not, I should talk to somebody who knows what they're talking about to see if there's if there's an exemption or something like that. But I think when we're talking single family homes, it's a lot easier to structure things as long as it's one investor, or you just bring me on as a legitimate joint venture partner where we're all actively involved, and as long as that's a small enough number, meaning four other partners, so that's 5 total. There's creative ways to structure them so that we are not a security, but not just smoke and mirrors. It's a structural thing that you have to work with.
And correct me if I'm wrong, Mauricio, but in general, the biggest risk is if somebody loses money. Nobody's ever going to complain to the SEC if they get all their money. And so it's when somebody loses money that there's a risk, because they go to the SEC, they complain, the SEC opens an investigation. And so it's typically times like now where the economy is kind of teetering, and things aren't always going well. I mean, for 10 years, everybody was making money, nobody was losing money, nobody was complaining to the SEC. And so we could have all been breaking the rules for the last 10 years and nobody would have gotten in trouble because nobody complained. But now suddenly things are going to go south on some of these deals, and that's when the risk really kicks in.
But by that theory though, why would anyone ever contact the SEC if they weren't filing as a security? Because if they were trying to claim that, okay, this is just a tick, or this is just, a joint venture, then if they were to contact the SEC, they'd be calling it on themselves, wouldn't they?
No, I'm saying the investors, the passive investors, who
right, but they're not passive though. If they're not registered as, correct me if I'm wrong here, but basically one of the telltale signs is whether or not the people involved in the deal are passive. And the moment you have passive investors who aren't actively involved in the deal, you automatically have to become a security, right?
Yeah, so what Jay's point, and by the way, I want to point out that your hat is starting to get crooked. So we're 55 minutes in. So I see that your backwards hat is starting to get a little crooked, which is our usual telltale sign here. But no, Jay's point is that there is something called sort of it's not an official thing, but it's called like sort of the golden rule defense, which means no matter how much you violate securities laws, if at the end of the day somebody gives you money and and this happens all the time, where people blatantly violate securities laws, but at the end of the day you end up selling the property and everybody makes a bunch of money. Nobody's going to find out. Nobody's going to complain. Like, the investor's not going to go in there and complain. The biggest issue, which is really the main point that Jay's bringing out, but I want to emphasize, is that when you don't follow securities laws, whether you don't know that you should or you just decide not to, what you're essentially doing is guaranteeing that investment. Meaning, if somebody's loaning you money and you should have done something and you didn't, then what you're saying is, I'm going to guarantee you that return. If the return's 10%, then even if it's an unsecured loan, if it goes south, I'm going to end up paying you that money, even if it wasn't my fault, even though the money got lost because the market turned or because there was a fire or because whatever, it doesn't matter, because the violation of the securities laws, my remedy for that is restitution, which means I've got to give you that money back plus interest. So I always tell people, it's like, who here is in the business of who here is in the business of guaranteeing your investors' money? Because that's really what you're doing. You're guaranteeing the money because, again, even if you didn't do anything wrong, plenty of people lost money in 2008, 2009. I didn't see too many lawsuits flying around. I'm sure there were, but people lost money because, nobody could have seen this coming. Oh my goodness, the capital markets froze up and I bought this property and I needed to refinance and all of a sudden there was no financing and everybody lost a bunch of money. But if you violated securities laws, that would be problematic, not because you did something wrong on the management side or the structural side, it's because you didn't follow the rules. And the investors then would call up the SEC and said, hey, I lost my money and this person didn't do it right. And that's how really somebody would open up an investigation and start through that process.
But wouldn't they be calling it on themselves then? I guess is my point, is if you didn't.
No, because I see what you're saying. No, the violation isn't from the investor. If I give Leka $100,000, I'm under no obligation to follow any rules or register anything. The registration happens on the person who's actually issuing the security, which in this case is the promissory note. So Leka gives me the promissory note. I give Leka money. All of the obligations are on her side, not on mine. So I'm not calling myself.
But in your example before, though, like you give Leka $100,000 and you get 15% of her LLC in exchange for that, then you're now an active member of that, even if you aren't doing anything. You're passive. So like, wouldn't you, to what I was trying to say is, if you all of a sudden lost that and you tried to call the SEC, wouldn't you be calling it on yourself? Because like you're the, technically the member of that.
Yeah, but I'm not the issuer, right? So the issuer is going to be Leka. She's the one who actually issued me the security. I ended up, just like in your syndication, right? A bunch of investors end up being members of your LLC, but that's because they purchased a percentage of that LLC. So the issuer is going to be Leka. So what I would just say is, look, I know technically I was a co-manager, but that was all wink, wink. I really didn't do anything. I just look at all the facts. I never showed up anywhere. I didn't do anything. And so this was an unregistered security. I want my money back. So that's how it usually happens. To Jay's point, the SEC isn't, auditing every single deal or doesn't have the manpower to do any of that stuff. But it really generally happens when investors start losing money. that's when they pick up the phone and well, first they try and get their money back, and then they start picking up the phone. Just like in in regular securities, I used to work at a securities firm. I mean, guess where the best time for my old firm was? It was when the stock market tanked, because when the stock market tanks, all those investors will start suing their brokerage house and say, hey, I lost all this money. You never told me I could lose this money. And there was all this litigation going on. That's how the lawyers made all their money, was the years following a huge crash in the stock market, because that's when everybody complained.
So, Leka, you do sometimes you have done syndications in the past, right? So you obviously choose sometimes to do syndications, and other times you choose not to do syndications. So what's kind of your criteria on a deal of when you would do a syndication versus you would do, a joint venture or some other structure?
So honestly, I do not like doing syndications. I do not like going out and raising 50 grand and 100 grand from like hundreds of people. I'd rather just, have one private investor per deal, and then just do my own like smaller flips or long-term holds. The only reason I would do a syndication is if, like Mauricio said, that the investment calls for one. So if I'm buying an apartment building and, we're fixing it significantly, we know that we're going to increase the value. We know we're going to take rents up. So I just did a syndication on an apartment building where rents were $8,500 a month coming in. We fixed it up and now it's like 22 grand a month, which, we know that we can significantly improve the value of this property and it's a sure shot deal. Then we'll do a syndication. But other than that, like, I don't honestly like raising capital from lots of people. And I just like to stick to what I'm really good at, which is just fixing distressed properties. So I'd rather do that on my short-term flips, because flips in my market, like if done right, can yield anywhere from a $200,000 to $300,000 profit. With no money of my own invested in the deal, I can make one investor a lot of cash, a lot of profit. And so it just works over and over again. It doesn't matter the market. It doesn't matter the timing. It just works.
And do you have like one, is it like, not, you don't have to reveal names or anything, but do you have like one sugar daddy or sugar mama that just is funding? Or do you have like 4 or 5 that just, you can go to them and say, hey, I need 100, Mauricio, I need 100 grand, or I need 200 grand. And they know you well enough that they're comfortable lending you on that particular project?
Yeah, so that's a great question. The way that I've been successful in raising capital is my city is extremely tech forward. So we have a lot of tech employees with a lot of capital. And especially since the stock market has been so volatile, they all want to invest in something other than the stock market. And they all want to invest in real estate. So we've started to see large real estate clubs in like Google, Facebook, Amazon. And I actually do presentations in each of these companies, large tech companies, where I have 200, 300 people in Microsoft come to my real estate presentation. And if they really like what they see, and the beauty of it is that everyone's local, so they can actually walk to some of my properties. I've done property walkthroughs before, and I'm like, hey, this is what I bought it for. This is how I'm going to fix it up. And here's the address. So when it sells on Redfin, you can see exactly what it's sold for, like being completely transparent and upfront. And they can actually see that process. Then they want to invest with me. So then I bring on like just say one person from Amazon, or like this morning I had a call with someone at Meta that, he's just got so much cash sitting on the sidelines and he wants to learn about real estate investing. So then I bring on someone from the tech world to come into my world, and then they get like just exposure to everything. How do I buy these deals? How do I find them? Who my wholesalers are, who my contractors are? How do I fix it up? And then how do we position it to sell it at the highest maximum value? Like how do we stage all our properties? We do amazing marketing. We hire the best listing team, and then we sell it, right? So then they actually get to see the entire process. And every investor that I've had, fortunately or unfortunately, fortunately for them, unfortunately for me, they learn so much through the process that they can then start off their real estate investing career on their own. And then my last private investor has now bought a house. He's going to flip the house, put 3 dados in the back and 1 ADU, and just make a killing on this project. And all that confidence he got from just being on this one project with me. And so I just repeat that process over and over and over again. I just feel like these people are so earnest. They're extremely smart. They're really good with their finances. They're logical. And so they're willing to put in the hard work. So I'd much rather bring on someone like that want to be involved in the process and one day become full-time real estate investors, and then take them through my process.
What a great first of all, what a great learning experience for the investor that's giving you the cash, and then also I'm sure you're capturing a ton of referrals and testimonials from those. If they can just invest with you for 1 or 2 times and then go do it on your own, I mean that shows a lot. So that's a great model.
And I'm sure there's quite a few times where someone thinks they're going to go off and they do all this work and they may or may not do a great job, and then they're like, this isn't worth all the effort. I can get almost as much just by investing passively with Leka. I'm just going to go back to doing that.
Yeah, it has happened. A lot of times people are like, okay, I'm going to go buy my flip. And then I'm helping them on this from the sidelines because they're like, oh my God, this is so much worse than I thought it was going to be. Or like, I just don't have the bandwidth because I am still a full-time tech employee. So then, but either way, I think they learn a ton. And so it's just good to kind of expose them to it.
Fair. All right, Jay, any last comments before we move on?
No, I absolutely love that model. And Carol and I, my wife Carol and I, spoke at Google a few years ago, and we've spoken at Amazon before, and it is a tremendously amazing pipeline for investors because if you can convince people that you're reputable, you're trustworthy, you know what you're doing, they've got a lot of capital looking to deploy. And so I highly recommend anybody out there figure out who that network of yours is. Maybe it's tech, maybe it's maybe you're in with a bunch of doctors or lawyers or engineers or whatever it is. Figure out who that high net worth group of people that you can kind of pitch to and get an audience.
Yeah.
Fair enough. All right, we ready for a top 10?
Let's do it.
Geez.
So Mauricio, I would love some positivity out of you at some point, but it's not going to come today because I don't think you're going to.
After your whole fantasy football debacle on my team,
You're just bitter that I beat you.
I think the whole thing's rigged. I'm going on
Well,
record.
everyone would have beat you. You got 70 points. All right. So top 10 this week is, since we were talking about syndications, it's the top 10 syndicators in multifamily housing as put on by NMHC, which is the National Multifamily Housing Council, their 2022 list.
I better be on there.
Well, so that was the funny thing, whereas most people would think, oh, someone like Grant Cardone, he's got to be the highest one. But Grant Cardone's got 12,000 units. Even to crack the top 10, the lowest one is 24,728 units. So I'll just go run down through these really quickly, and I think you're going to be shocked by how high the numbers we get up here. Because number 10, the John Stewart Company from San Francisco, as I said, 24,000.
Sam Sell's got to be on there somewhere, by the way.
We bump up to WNC, also in California. They're up to 62,000. Hunt Capital, 71,000. Then we keep going higher. The Richmond Group, 102,000. Alliant Capital, which most people have heard of, 110,000. Enterprise Housing Credit Investments, 114. National Equity, 115. PNC is 140. Raymond James, 141. And then all the way at the top, number 1 is the Boston Financial Investment Management Group. They have 180,000 units.
Holy.
Syndicated. So when you think Grant Cardone at 12,000 with his jets and his Mr. Billionaire is way up there, then he's quite a ways off of 180,000 units.
I'm going to object already because I said Sam Zell. Sam Zell, according to this, and it's in Google, so it's got to be true. 78,000 apartments. How come he's not on? Or maybe it's just one of those REITs that you mentioned.
Does he syndicate? I don't think he syndicates.
Yeah, do you think he's got 70,000 apartments out of his own pocket? Like,
I don't know. Maybe he's through one of these groups, but this is coming straight from NMHC, so they know their.
That's my favorite top 10, I have to say.
Wow, I just thought it was interesting that how many units some of these people own.
Yeah, I think that's a great point. Everybody thinks of X and Y as major syndicators, and they're barely cracking 10, 15,000 units or something, and these guys are, like you said, 40K just to crack the top 10.
I mean, I'd still take Cardone's numbers, but who's the count? All right, quick question. So we're doing for a game, we're doing a crowd question coming at you. We'll start with Jay. Who is your favorite celebrity that you follow the most, either online or movies, or who's your number one?
I'm not a celebrity guy. Like, I don't follow anybody.
Oh my God, Jay. Once again, I gave you this question in advance. You had all the time in the world to come up with an answer, and I come to you and you still don't have an answer.
I came up with my answer in about 3 seconds. There are no celebrities that I follow.
Oh my God. Just pick one, Jay.
You.
Okay.
I've been to your Wikipedia page. I check all your emails when you
So wait,
send
are
them
you the
to
one
me.
who keeps changing my Wikipedia page? I knew it.
That's a really good idea.
All right. I know Leka's got a good one for me.
It's actually, you guys are not surprising at all, but I follow them because I think they're just so scandalous and entertaining. It has to be the Kardashians.
Anyone in particular? Who's your go-to number one?
I would say Kylie. It switches between Kylie and Kim, because they each have something so exciting and interesting happening in their lives. Not to mention the cool hairstyles, the body changes,
When Kylie's the only billionaire in the group, right?
right, and she's not even a billionaire anymore. But yeah,
High interest rates hit everyone. Mauricio, who's your go-to?
I'm gonna have to say Princess Elsa is probably high up there, my celebrity that I have to follow with my 2 little girls that I've got. So, but if it's not Princess Elsa,
Who's it? Wasn't it Idina Menzel? Isn't that her name? The who does?
yeah,
Princess
one of the
Elsa?
two. I forget who that is, or the other gal who does Princess Anna or whatever. So yeah, but the 2 princesses are probably the biggest celebrities that I follow these days.
that's cute, Mauricio. That's cute.
Anybody who's listened to our previous podcast back in the day knows I'm going with The Rock. It's tough not to follow that guy. He had a bit of a rough patch there when he became the butt of the jokes with the his little Maui presentation with Oprah. But in general, he's very scandal free. He usually does the right thing, and the guy works his ass off. He's always doing stuff. So I like following him.
Sorry, The Rock on Instagram or The Rock on Twitter?
I don't do Twitter. I'm all Instagram for
I'm
him.
gonna go follow him now.
Oh yeah, he's great.
I'm a big fan of, now that you mentioned The Rock, I know he hangs out with Kevin Hart a lot. And I'm a big Kevin Hart fan. I don't necessarily follow him, but I'm likely to click on something if I see a YouTube video or something on him. He's great. What I love about him and is that obviously he's a comedian, but outside of when he's not a comedian, he's serious. He's a pretty freaking smart dude, a really big business guy too.
I started following those that Burt Kirshner and Tom Segura too. They have a podcast together now. I think it's 2 bears, 1 cave or something, and they're just two comedians, and the 2 guys they're pretty funny. They feed off each other, and they're very sarcastic, and I like those guys too.
Love it.
All right. So Jay, if I ask you for a plug, are you going to actually have one of those this week, or do I have to come back again next week? You're just going to say, like and subscribe our podcast.
Hey, but wait. We hit 500 though. We hit 500. Thanks to Jay.
500. There you go.
We hit 500.
Jay, you got something for us or no?
Come back to me.
Oh my God. Mauricio, what's your plug for the week?
I started a new thing called Mondays with Mauricio with my syndication community, the real estate syndicator community on Facebook. So come follow us over there and join me. It's just go to Real Estate Syndicator Community. It's the one I run. It's got about 3,000 syndicators, and so really good group of syndicators who really contribute and add a lot of value, which is obviously what I want. And we keep all the spam out and all the good stuff in.
So did you pick Monday because it's a good day for you, or just because you could put it with your name?
I can put it with my name. I've been trying to do a Monday with Mauricio for a while. I'm like, maybe this could be it. It might change. It might end up being a whiteboard series or something. But for now, it's going to be my Monday little live Zoom call with the community.
Fair enough. Leka, you got anything you want to plug for us?
Yeah, for sure. If it's a plug for the week, then I am actually interviewing live. I'm interviewing ex-Seattle Seahawk and NFL legend Doug Baldwin this week on Wednesday in Seattle. And we're going to talk about, he has just such a fascinating story. And I've always been a big fan of his because he is one of those players that just inspired me, even when he was was playing in the Seahawks and won the Super Bowl for us. But he went from being an NFL superstar to being a complete entrepreneur. And what he's done, and just like the business he's built past the NFL, I think just showed a lot of foresight on his part. And he took what he knew best to go build this fantastic sick team to take on incredible projects, especially projects that really relate to the Seattle community and giving back. So he just has a really cool story, and I'm excited to interview him.
Awesome. Where can we check that out?
I'll send you a link, and you can post on the video.
We'll drop it in the description, the show notes.
I will do that.
Do we point down? Point, is that right below? Just
Yeah, just look below.
Look right here.
Link right here.
Jay, last chance. You got something?
Follow me on Instagram, Facebook, and LinkedIn, J Scott Investor.
Wow, that's lame.
Wow. All that time. That's what you came up with. All right. Well, once again, I'm going to plug my wife, Ashley. I love plugging her every night. So Badass Investor.
She's thebomb.com. If you don't follow her, you're really missing out.
Yep. Instagram, Badass Investor. YouTube with her shorts, Badass Investor. You'll get some great content, and she looks pretty good doing it. So I don't know about you guys, but my drink is gone. I think I'm going to go hit the head. Once again, thank you. Little small clap for Leka for joining us. Thanks, Leka.
Thank you, Leka.
Thank you, boys, for having me. This has actually been so much fun.
Yeah, well, we appreciate you coming out.
How much of your bottle is still left, though? You've barely.
You guys, look.
Oh! Did you just pour that on your lap?
You drink the whole bottle?
Pops is gone. It's all gone.
Wow, that's awesome.
Just a dribble.
Right.
It's just a dribble.
We'll drink some in Orlando at the BP Con.
I would need a lot of shots then, Mauricio. I'm counting on you to back me over there.
Oh, speaking of which, Ashley's her horse show might be she might not be going anymore. So get on her, work on her to go to BP Con with you guys.
Well, no. We need to work on her to stay home with the kids so you can come to BP Con and we can record from there.
Wow, no, you need the networking. You don't need me sitting in the corner only talking to the people I already know and like.
That's what I do.
I don't know. You did help me, charge my phone last year because you had that big old charger. So I think you are equally important. And I suggest that you guys leave the kids with the in-laws or in London and both of you show up.
That would be nice, except BP Con, they always do it like Monday to Wednesday, like in the middle of school. So like, unless if they could go back to doing the weekends like they did in the beginning, I don't know if it's cheaper, but yeah.
I mean, Kyle, how old are your kids? I think they can watch themselves.
6 and 8. Yeah, my 8-year-old's just I come home and if the house was burned down, I would be happy with that outcome, leaving the two of them because at least they're alive. All right. Well, once again, thanks to Leka. For everyone else, I will see you next Tuesday.
See you guys.
Bye, guys.
Bye.